Something extraordinary is happening in the gold market right now, and if you own gold, or if you've been thinking about buying gold, you need to understand what's unfolding because the next few weeks could determine whether you're positioned correctly for what's coming. Let me start with something that happened just 72 hours ago that most people completely missed. The COMEX gold futures market saw something we haven't seen in over a decade. The open interest in gold contracts surged by 47,000 contracts in a single session while the price barely moved. Now, if you don't follow futures markets closely, let me explain why this matters. When you see massive increases in open interest without corresponding price movement, it tells you that someone, somewhere, is building an enormous position, and they're doing it quietly. But here's where it gets interesting. At the exact same time this was happening on the COMEX, we saw physical gold withdrawals from the London Bullion Market Association vaults hit their highest level since March 2023. We're talking about 127 metric tons leaving the vaults in just 5 trading days. That's not normal market activity. That's institutional accumulation on a scale that suggests someone knows something the rest of the market hasn't figured out yet. Now, I want you to think about what's happening in the broader financial system right now because this is where all the pieces start connecting. The Federal Reserve just released their latest balance sheet data, and buried in those numbers is something that should make every gold owner pay very close attention. The Fed's reverse repo facility, which is essentially where money market funds park their cash overnight, has dropped from $2.3 trillion at its peak to just under $400 billion today. That's nearly $2 trillion that has flooded back into the financial system over the past 18 months. Where did that money go? Well, some of it went into stocks, which is why we've seen the market rally. Some went into bonds. But here's what the mainstream financial media isn't telling you. A significant portion of that liquidity is now sitting in money market funds and short-term treasuries, earning yields that are still attractive, but with a growing problem. The people managing that money are starting to realize that those yields, even at 5%, aren't keeping pace with real inflation. And this is where the gold story gets really compelling because when you look at what's actually happening with prices in the real economy, not the government's carefully massaged CPI numbers, but what people are actually paying for food, for energy, for housing, for insurance, you start to understand why institutional money is quietly rotating into hard assets. Let me give you a specific example that illustrates this perfectly. There's a pension fund manager in Texas, manages about $8 billion in assets, and he told me something fascinating last month. He said his fund has been required by their board to maintain a 7% annual return to meet their obligations to retirees. For years, they could do that with a traditional 60-40 portfolio, stocks and bonds. But now, even with stocks near all-time highs, he's looking at his projections and realizing that the math doesn't work anymore. Bond yields, even at current levels, aren't enough. Stock valuations are stretched. And the real kicker is that his actuaries are telling him that the cost of living for their retirees is rising at nearly 8% annually when you factor in healthcare, property taxes, and actual food costs. So what's he doing? He's been systematically moving 5% of the fund into physical gold. Not gold ETFs, not gold mining stocks. Physical gold stored in allocated accounts. And he's not alone. I'm hearing the same story from pension managers across the country. They're looking at gold not as a speculation, but as the only asset class that has historically maintained purchasing power over long time horizons when everything else is failing to keep up with real inflation. Now let's talk about what's happening with central banks because this is where the story gets even more interesting. The World Gold Council just released their latest data, and central banks bought 183 tons of gold in the third quarter alone. That's the third consecutive quarter of purchases above 150 tons. But here's what's remarkable. The buying isn't coming from the usual suspects. Yes, China is buying. Yes, Russia continues to accumulate despite sanctions. But the real story is countries like Poland, Singapore, and the Czech Republic, nations that have historically held relatively modest gold reserves, are now buying aggressively. Why? Because they're watching what's happening with the dollar's role in the global financial system, and they're hedging. When the United States froze Russia's dollar reserves after the Ukraine invasion, it sent a message to every central bank in the world. Your dollar reserves aren't really yours if the U.S. decides they're not. Gold, on the other hand, can't be frozen, can't be sanctioned, can't be devalued by another country's monetary policy. And this brings me to something that's happening right now that could be the catalyst for the next major move in gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are meeting next month, and on the agenda is a discussion about a new settlement system for international trade that would bypass the dollar now. I'm not saying they're going to announce a gold-backed currency. That's probably years away if it happens at all. But what they are doing is building the infrastructure for bilateral trade settlements in local currencies, with gold potentially serving as a balancing mechanism. Think about what this means. For 50 years, since Nixon closed the gold window in 1971, the dollar has been the undisputed reserve currency of the world. Countries needed dollars to buy oil, to settle international trade, to hold as reserves. That created constant demand for dollars, which allowed the United States to run massive deficits without consequence. But that system is starting to crack. Not collapse, not yet, but crack. And every crack in the dollar system is a tailwind for gold. Let me take you back to 1971 for a moment, because there's a lesson here that's directly relevant to what's happening today. When Nixon closed the gold window, when he announced that the United States would no longer convert dollars to gold at $35 an ounce, gold was trading at exactly that price, $35. Within 2 years, it had more than tripled to $120. By 1980, it hit $850. That's a 24-fold increase in less than a decade. Now, what caused that? It wasn't just the end of gold convertibility. It was what came after. Inflation surged. The Fed, under Arthur Burns, kept interest rates too low for too long, trying to support the economy and the stock market. Sound familiar? By the time Paul Volcker took over in 1979 and jacked rates up to 20%, the damage was done. The dollar had lost more than half its purchasing power, and gold had become the only safe haven that actually preserved wealth. Here's what's different today, and in some ways more concerning. In the 1970s, the U.S. was still a creditor nation. We still had manufacturing. We still had a trade surplus in many years. Today, we're running trillion-dollar deficits as far as the eye can see. We've got $34 trillion in national debt. We've got unfunded liabilities in Social Security and Medicare that dwarf even that number. And we've got a political system that shows absolutely no willingness to address any of it. The Fed is trapped. If they keep rates high to fight inflation, they risk breaking something in the financial system. We already saw that with the regional bank crisis last year. Silicon Valley Bank, Signature Bank, First Republic, all went under because they were sitting on massive unrealized losses in their bond portfolios. If they cut rates too quickly, inflation comes roaring back. They're trying to thread a needle, and the margin for error is razor thin. And this is where gold becomes not just an investment, but insurance. Because here's what history tells us. In every major financial crisis, in every period of currency debasement, in every era of unsustainable government debt, gold has been the asset that maintains its value. Not because gold itself changes, but because everything else, the currencies, the bonds, the promises, they lose credibility. Now, let me address something important here, because if you're sitting on retirement savings, if you've got $100,000 or more in traditional IRAs or 401ks, you need to understand that there are ways to get physical gold into those accounts without triggering taxes or penalties. I put together a comprehensive guide on how gold IRAs actually work, the rules, the custodians, the storage requirements, all of it. You'll find that in the description below. It's worth looking at if you're thinking about diversifying your retirement holdings into physical metals. No pressure, but it's there if you want to understand your options. All right, back to what's happening in the market right now. Because there's another piece of this puzzle that's absolutely critical, and it has to do with the supply side of the gold equation. Gold mining production has essentially been flat for the past 5 years. We're producing about 3,500 tons of gold annually from mines around the world, and that number isn't growing. In fact, many of the major mining companies are reporting that their reserve replacement rates are declining. They're mining gold faster than they're finding new deposits. Why does this matter? Because unlike paper assets that can be created with a keystroke, gold is a physical commodity with real supply constraints. And when you've got flat supply meeting rising demand from central banks, from institutional investors, from individual buyers in countries like India and China where gold is deeply embedded in the culture, you've got to set up for a supply squeeze. And we're already seeing signs of stress in the physical market. The premiums on physical gold coins and bars have been elevated for months now. The U.S. Mint has had trouble keeping up with demand for American gold eagles. Dealers are reporting longer wait times for delivery. These are the early warning signs that the paper price and the physical price are starting to diverge. Now, let me explain something about how the gold market actually works, because this is important for understanding what could happen next. The price you see quoted, the spot price of gold, that's determined primarily by trading on the COMEX futures exchange and in the London over-the-counter market. The vast majority of that trading is in paper gold, contracts that represent gold but aren't backed by physical metal on a one-to-one basis. The COMEX, for example, operates on a fractional reserve system. They've got about 20 million ounces of physical gold in their vaults, but there are contracts outstanding representing far more than that. As long as most contract holders settle in cash rather than demanding delivery, the system works fine. But if we ever get to a point where a significant number of holders demand physical delivery, the whole structure could come under severe stress. And here's why that matters right now. We're seeing increasing evidence that large players, sovereign wealth funds, family offices, major institutions, are starting to prefer physical settlement over cash settlement. They want the actual metal, and every ounce that leaves the COMEX vaults is one less ounce available to back the paper contracts. This is exactly what happened in the silver market in 2021 during the Reddit-driven squeeze. The price of physical silver coins and bars surged to $15 over spot at one point because there simply wasn't enough physical metal available to meet demand, even though the paper price was being suppressed through futures trading. Gold is a much bigger, more liquid market, so it's harder to squeeze, but the same dynamics apply. If physical demand overwhelms available supply, the paper price will eventually have to catch up. Let me give you another historical parallel that's relevant here. In 2008, during the financial crisis, something fascinating happened in the gold market. In September and October of that year, as Lehman Brothers collapsed and the financial system was in freefall, the paper price of gold actually dropped from $900 to $700. But if you tried to buy physical gold during that period, you couldn't find it at anywhere near that price. Dealers were sold out. Premiums were 20%, 30%, sometimes 40% over spot. The paper price and the physical price completely disconnected. Why? Because in a crisis, people don't want a contract that promises to deliver gold. They want the actual metal in their possession. And we could be heading into a similar dynamic, except this time, the underlying fundamentals are even more supportive of higher gold prices. Think about what's happening geopolitically right now. We've got ongoing tensions between the US and China over Taiwan, over trade, over technology. We've got the war in Ukraine, which has already gone on far longer than most people expected. We've got instability in the Middle East. We've got elections coming up in multiple major economies where the outcomes could significantly shift policy directions. Every one of these situations creates uncertainty, and uncertainty drives demand for safe haven assets. But here's what's really important to understand. Gold isn't just responding to crisis anymore. It's responding to the structural changes in the global financial system. The de-dollarization trend isn't going away. The debt levels aren't going down. The political dysfunction isn't getting better. These are long-term secular trends that support higher gold prices over time. And when you look at gold from a valuation perspective, it's actually not expensive relative to other assets. The gold to S&P 500 ratio, which measures how many ounces of gold it takes to buy the S&P 500 index, is still well below its historical average. Gold relative to the money supply, gold relative to government debt, gold relative to the Fed's balance sheet, by all these measures, gold is nowhere near the extremes we saw in 1980 or even in 2011. In 1980, gold hit $850 an ounce when the Dow Jones was around 800. It took more than 1 ounce of gold to buy the Dow. Today, gold is around $2,000 and the S&P 500 is over 4,500. The ratio is completely different. If gold were to reach the same relative valuation it had in 1980, we'd be talking about prices north of $10,000 an ounce. Now, I'm not predicting that. I'm not saying gold is going to $10,000. But I am saying that from a historical valuation perspective, there's plenty of room for gold to move higher. And here's something else to consider. The younger generation, millennials and Gen Z, are starting to buy gold in ways that previous generations didn't. They're buying it through apps, through fractional ownership platforms, through crypto-backed gold tokens. They're viewing gold not as their grandfather's boring investment, but as a hedge against a system they fundamentally don't trust. They've watched the 2008 crisis. They've watched the COVID money printing. They've watched inflation erode their purchasing power, and they're looking for alternatives. This is creating a new source of demand that didn't exist in previous gold bull markets. And it's demand that's likely to grow as economic uncertainty continues. Now, let's talk about what you should be watching in the coming weeks, because there are specific indicators that will tell us whether this setup is going to play out. First, watch the dollar index. Gold and the dollar typically move inversely. If the dollar starts to weaken, particularly if it breaks below the 100 level on the DXY index, that's going to be rocket fuel for gold. Second, watch real interest rates. Real rates, that's nominal rates minus inflation, are the biggest driver of gold prices. If real rates turn negative, meaning inflation is higher than interest rates, gold historically performs extremely well. Third, watch the COMEX inventory levels. If we see continued drawdowns in registered gold, the gold that's available for delivery, that's a sign that physical demand is overwhelming supply. Fourth, watch what central banks are doing. If the pace of central bank buying accelerates from here, that's a major bullish signal. And finally, watch the mining stocks. Gold mining stocks typically lead the metal itself. If you start seeing the major miners, companies like Newmont, Barrick, Agnico Eagle, breaking out to new highs, that's often a precursor to a major move in the gold price. Here's what I think is going to happen, and this is just my analysis based on everything I'm seeing. I think we're in the early stages of a multi-year bull market in gold that's going to take us significantly higher than where we are today. I think the combination of central bank buying, institutional accumulation, supply constraints, geopolitical uncertainty, and currency debasement is creating a perfect storm for gold. But here's the key. This isn't going to be a straight lineup. There will be pullbacks. There will be periods where it feels like nothing is happening. The gold market is notorious for testing the patience of its holders. But if you understand the fundamentals, if you understand why you own gold, those pullbacks become buying opportunities rather than reasons to panic. And this is where I want to address something important. Gold is not a get-rich-quick scheme. It's not a momentum trade. It's not something you buy, hoping to flip it for a quick profit. Gold is wealth insurance. It's the asset you own because you understand that every paper currency in history has eventually failed, and you want to make sure that a portion of your wealth is held in something that has maintained its value for 5,000 years. When the Roman Empire collapsed, gold was still valuable. When the Weimar Republic printed itself into hyperinflation, gold preserved wealth. When the Soviet Union fell apart, gold was the currency that mattered. This isn't about being a doom and gloomer. This is about being a realist who understands history and understands that the current financial system, built on unlimited debt and money printing, is not sustainable long-term. So if you own gold right now, my advice is simple. Understand why you own it. Make sure you're holding physical metal or allocated storage, not just paper promises. Be patient, and be prepared to add to your position on any significant pullbacks. If you don't own gold yet, but you're thinking about it, now is the time to start doing your homework. Understand the different ways to own gold. Understand the tax implications. Understand storage and security. And most importantly, understand that gold is a long-term hold, not a short-term trade. The next few months are going to be critical. We're at a point where the market could break out to new all-time highs, or we could see a consolidation that tests the patience of holders. But either way, the long-term trajectory is clear. The fundamentals have never been more supportive of higher gold prices. The question isn't whether gold is going higher. The question is whether you're positioned to benefit when it does. Watch the market closely. Pay attention to the indicators I mentioned. And most importantly, make sure your portfolio reflects the reality of the world we're living in, not the world we wish we were living in. Because the greatest risk isn't owning gold and being wrong. The greatest risk is not owning gold and being right about everything else.